أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم الحمد لله والصلاة والسلام على رسول الله وعلى آله وبارك وسلم. Assalamu alaikum, dear students. I welcome you all to the subject International Financial Management. This subject is basically authored by Jeff Medora, who is the lecturer at professor at Florida Atlantic University. We follow the book and the lecture notes of Jeff Medora to cover the contents of your course of international finance in 8th semester. So inshallah, today is our first video lecture series. In this video lecture series will start from chapter number 2, because we have studied chapter number 1 in the class, and if you do have any questions in chapter number 1 in all the topics that we have covered in that chapter, please come back to me with your questions and I'll be more than happy to respond to those questions. So today's discussion will be on chapter number 2. In this chapter we'll be discussing components of balance of payments, how to explain how the international trade flows and influenced by economic factors and other factors, means how international trade takes place and what are the economic factors which affect the international trade, and also what are the other factors which affect the international trade. And also we'll have discussion on international capital flows and how they are influenced by country characteristics. So these are the chapter contents. In this chapter there are these 3 main topics that will be covered, and also we'll have discussion on agencies that facilitate the international flow of trade and capital. So basically 4 topics are going to be covered in this chapter. But today's lecture will focus on the balance of payment. So we'll have discussion on what balance of payment is and how it's important for us to understand as students of the international finance or international financial management. In the introduction of balance of payments, I would say that it's basically a tool or a report, or we can say a financial report or an accounting report of a country's transactions, which could be transactions related to flow of funds, means flow of funds coming into the country and flow of funds going out of the country. So it's basically prepared by the country, by specific countries. Each country prepares balance of payments to keep track of their cash flow, cash flows, or of all the transactions where there is a flow of funds coming into the country and going out of the country. So it's basically a type of cash flow statement that we as a business runners, finance manager prepare in order to keep track of flow of funds in a business organization. And you guys all know in finance we have a saying. It says finance is the lifeblood of an organization and cash is the king, which means that without finances organizations cannot survive, and without having sufficient cash we cannot make successful business decisions. So all the business decisions are based on the cash flows or cash available on hand. So that's why we say cash is the king. all the decisions are made based on the what? Based on the cash. And in previous chapter we discussed that for a multinational corporation there are 4 main financial management decisions. Number 1 was working capital management decision, number 2 was investing decision, number 3 was financing decision, and number 4 and most important one was the dividend distribution decision or dividend decision. So if you look at all these 3 decisions, there is always money coming in to the organization or money going out of the organizations, and these decisions are made based on the availability of cash. So, and in order to keep track of all these decisions, we prepare a financial statement which is called cash flow statement. But how do the countries keep track of such transactions involving cash inflow and cash outflow? They keep track of those transactions by preparing the balance of payments. So you know that cash flow statement has 3 main components. It's called cash flow from operating activities, then we have cash flow from investing activities, and then we have cash flow from financing activities. Similarly, balance of payments has also 3 components, which we will discuss later on, and it's same as the cash flow statement, but cash flow statement is on company base, but balance of payments is on country base. It's for the whole country. So that is enough for the introduction of balance of payment, and I gave you a comparison of the cash flow statement with the balance of trade for the better balance of payments for the better understanding of what in how balance of payments work. The importance or the question why we as a finance students or international finance students need to understand the balance of payments. It's because as a multinational corporation we need to understand how each country is performing, and the performance of the of a country can be known or can be tracked with the help of balance of payments. So in order to understand each country's economy, we need to understand balance of payments. And other reason is multinational corporations are always involved with the international trade, with international foreign direct investment, portfolio investments, purchase of assets, sales of assets, finance, investing in financial securities or financing through financial securities on international market. So all these transactions, they are like the part of balance of payments. They should be recorded in each country's balance of payment account. So that's why balance of payment account records these transactions which are related to a specific country, and we as a multinational corporation runner need to understand how each country is dealing with the transactions related to cash flow, and we are the part of all these transactions. So that's why we need to understand the balance of payments account and the activities or the transactions recorded by the balance of payment accounts, especially of those countries where we have our business, or from where we do financing, or where we do investing, or to where we export, or from where we import. So that's why it's very, very important to understand the balance of payments account. Okay, now that was, I think it's enough for the introduction of balance of payment. Let's go ahead and see what we have next on the slides. As we already know that in order to carry out international business, we have to choose One of the methods from multinational business that we already have studied in first chapter. If you remember, we discussed at the end of the first chapter, we discussed the methods of international business or multinational business, which include international trade, licensing, franchising, joint venture, direct foreign investment or foreign direct investment, foreign portfolio investment. All these sources or methods are used to carry out multinational business, which we have discussed in details in the previous chapter. And so if we choose any method, the international business is facilitated by markets that allow the flow of funds between the countries. In that we already discussed in first chapter as well. We discussed the international financial environment of the multinational corporation, and there were various elements of that multinational financial environment of a multinational corporation. And the transactions arising from international business cause money flows from one country to another. The financial managers of MNCs monitor the balances of these flow of money so that they can determine how the flow of international transaction is changing over time, an indication that volume of transactions between specific countries. As I already discussed, that basically the balance of payments account is prepared by the country officials. But why do we need to understand it? It's because we need to understand, we need to monitor the balances of these flow of money arising from international transactions, so that we can determine how the flow of international transaction is changing over time, and also to determine the volume of transactions between specific countries, especially those countries where or from whom we export or import. So in order to keep track of all these transactions, we need to prepare or understand the balance of payments account. It's basically a financial or an accounting record, or we can say a financial report, right? So it says balance of payment is an accounting record of all monetary transactions between a country and the rest of the world. These transactions include payments for the country's exports and imports of goods, services, financial capital, and financial transfers. So these are the items. These are the items: export and imports of goods and services, financial capital, financial transactions. Means flow of funds from the export and import of goods and services, from the export and import of financial capital. Export means flow in, flow out. Similarly, financial transactions. So the record of all these transactions or flow of funds arising from these activities is recorded on the balance of payments account. The balance of payment accounts summarize international transactions for a specific period. As earlier discussed, it's a report, so it should be for a specific period. It could be, mostly it's for 1 year, but it could be for a multiple year, and we can present comparative data for multiple years. For example, we can prepare a balance of payments for 2 years, 3 years, 4 years, and 5 years to see the changes or increase or decrease in flow and outflow of the funds arising from different transactions, which is goods and services, financial capital, and financial transfers, to see if the country's exports or import are going up or going down. So sources of funds for a nation, such as exports or the receipts of loans and investments, are recorded as positive or surplus items. Uses of funds, such as for imports or to invest in foreign country, are recorded as negative or deficit items. This explains how we can record the transactions or entries in the balance of payment. There are two types of overall, there are two types of entries made within the balance of payment. entries for those transactions which causes money to come into the country, and entries of all those transactions which causes money to go out of the country. So all the transactions in which money comes into the country are recorded as positive figures to show the inflow, and all the transactions which causes the money go out of the country as outflow, they are recorded as negative figures to show that the money is flowing out of the country. So what are those transactions? Those transactions are exports, receipts of loans and investments. They are recorded as inflows in positive figures, whereas imports, investments, they are recorded as negative figures. Positive figures on the balance of payment account, positive figure is also called surplus, while negative figure is called deficit. So as discussed earlier, there are three elements basically of the balance of payments. Each element at the end should have a net positive or net negative figure. If there is a net positive figure, it will say net surplus. If it shows a net negative figure, we will say net deficit, right? Okay. We will show you practically in upcoming slides. A record of its further explanation on the balance of payments. A record of all the transactions made between one particular country and all the countries during a specific period of time. It compares the dollar difference of the amounts of exports and imports, including all financial exports and imports. A negative balance of payment means that more money is flowing out of the country than coming in, and vice versa. As I earlier discussed, whenever there is a negative figure, it means money is going out of the country. If it results in positive figure, it means more money is coming into the country. So positive figure is always deficit, and surplus, and negative figure is deficit, right? As I earlier said, each element or each part is netted out to see if it is positive or negative, or means surplus or deficit. At the end, we do a net of all the three parts to see what is the overall situation of the balance of payment, to find out what is the overall, where it is overall a negative figure means deficit, or overall a positive figure or surplus. Balance of payments may be used as an indicator of economic and political stability. For example, if a country has a consistently positive balance of payment, which could mean that there are significant foreign investments within the country. It may also mean that the country does not export much of its currency, means currency is not going out of the country. So currency is more coming into the country, which is a positive sign for in most of the times. Okay, so let's talk about the components. As I earlier discussed, that there are three components: current account, capital and financial account, and official settlement account. Some books refer that balance of payments basically has three elements as shown in this chart, in this model: current account, capital account, and financial account. But some books refer as the three elements of balance of payment as current account, capital and financial account, and official settlement account. Means sometimes 1, 2, and 3, these are shown as three different elements or components of the balance of payment, but sometimes capital and financial account is shown as one element, current account is other element, and official settlement account is other element. So let's see, it doesn't matter whatever format you follow, if you say three elements to be these three, it's also correct. If you say three elements of the balance of payments to be these three, it's also correct. It depends on the country to which format they follow or in what way they want to present their balance of payment account. So let's go ahead. One thing you have to keep in mind, that current account always accounts goods and services, all the transactions related to goods and services, all the money coming into the country and going out of the country for the purchase or sales of goods and services. In other words, we can say for the exports and imports of goods and services. Capital account always records transactions related to assets, right? Assets, purchase of fixed assets, foreign direct investment, right? So that is tangible assets. And financial account reports or records all the transactions related to investments and intangible assets, right? So that is the key difference between these three elements. So you have to know what should be recorded where and how. Okay, so it's the further elaborative structure of balance of payment. It further elaborates what comes under the current account, what comes under the capital account, and what comes under the reserves or official settlement account. So in current account, there is trade, there is transfer factor payments and invisibles. We'll later on discuss what is trade, what is transfer factor payments, and what are invisibles. Means all the money, cash flow of funds from trade, which is export and import, from transfer payments, which is basically payments made to the foreigners, and payments received from the foreigners. And as invisibles basically shows the transfer of money by the employees of one country working in another country. When they transfer their savings to their own country, it is regarded as invisibles, and they are also shown here. And capital account, foreign direct investment, we have portfolio investment, and we have NRE and NRI. Later on we will discuss what is NRE and NRI. We have reserves could be the reserve kept in the central bank of a country, which is gold, which is foreign exchange, and which is IMF loans, which are taken for long-term planning to achieve long-term goals by the country. So usually overall the countries in the world have the structure of balance of payments shown in this model. We will discuss further and elaborate it further in upcoming slides. Okay, so let's talk about the balance of payments components. What is the first component? The first component we have is the current account. So the current account, what is the current account? It summarizes the flow of funds between one specified country and all other countries due to purchases of goods or services, the provision of income on financial assets, or unilateral current transfers, which is called government grants, right? So basically in this part of the balance of payments, we record all the fund inflow and outflow arising from export and imports of goods and services, payment on financial assets or receipts on financial assets. It means that if citizens of a country has invested in other countries' financial assets, so that country is to pay return on that investment on financial assets. So that is recorded as outflow. And similarly, if the citizens of that country has invested in the financial assets of this country, so this country has also have to pay the interest or the return as income or premium or as dividend to the nationals of that country. So those are also recorded as payments or as income payments. And there are invisibles. We previously said invisibles. Those are basically unilateral current transfers, which means grants paid by a country, grants received by a country. When we pay, we report it as negative figure because money is outflow, and when we receive, so we record it as positive figure. So if you go to the previous slide, so you will now be it will be clear to you now. Here we record for the money inflow, foreign inflow and outflow from trade. Transfer factor payments, it represents the income payments on the financial assets or income receipts on the financial assets, which I elaborate. Invisible means grants, unilateral grants, or aids. Those grants or aids which are not to be returned back, unilateral, it's one-sided. So either it is a positive figure or negative figure. Mostly it's a negative figure because most of the countries, when they provide grants, so they record it as negative. And the countries who are strong enough, they do not receive any grant. So in those countries, mostly this figure is always negative. But in case of Afghanistan, it could be a positive figure because we receive a lot of grants as well. So hope it's clear to you guys. A current account deficit suggests that a greater outflow of funds from the specified country for its current transactions. The current account is commonly used to assess the balance of trade. From the current account, we basically find out the balance of trade. Balance of trade means the difference between the money coming in to the country and coming out of the country as a result of trade, which is export and import. So it means that we figure out or we measure through balance of payment. We want to see if our country is exporting more than importing, or whether the country is importing more than exporting. So when a country has a negative figure between the exports and imports, it's called balance of trade deficit, right? Trade deficit means that a country is importing more than that country is exporting. When we import, we pay money. When we export, we receive money. And a positive figure on balance of trade, it would mean trade surplus, and it will mean that this country is exporting more than importing from a specific country. Means when we export, we receive money from outside. So international currency, dollar, comes into the country. So that is about the trade surplus and trade deficit and trade balance. Okay, current account. Let's talk about the components of current account. There are three components of the current account. Payments from merchandise and services, I already explained that to you. Number two, factor income payments. It is basically interest and dividends payments received by a country, by an investor on foreign investments and financial assets, which is securities. Either we receive or either we pay. So if we receive, we record it as a positive figure, and if we pay, we record it as a negative figure. And then we have transfer payments. It represents aids, grants, gifts from one country to another. And as I explained, they are unilateral and mostly they are recorded as negative figures. And those countries who receive these grants, they are recorded as positive figures, right? So that was this is further elaborative shape of the components of current account. Already discussed to you guys. We have trade from export and import of goods and services. We have goods, and then we have trade and service, net factor income and net factor income, non-factor income. It's factor income and non-factor income. What's the difference between factor income and non-factor income? Factor income is basically employees. For example, other nationals are working in a specific country. When they receive their salary, they send back to their countries. So that is income factor. Factor income, right? Factor income is in two shapes. One is employees, second is investments. Employees means that when foreigners work in a specific country, they receive a salary, and that salary is sent back to their home country, so that is recorded as negative figure. Similarly, if a country's population work in another country, they receive income from that country and they send back to this country, so that money coming in from the employees in working in foreign country, from the citizen working in foreign country, it's recorded as positive figure. Net investment income, it's basically investment in financial assets, in financial securities. If Afghanistan people, or we can say Afghan population, has invested in financial assets of China, and China pays them income, that's recorded at positive figure in Afghanistan's current account, balance of payment of the current account. And similarly, if Chinese people has invested in Afghanistan's financial assets, which is not more likely, and Afghanistan government or Afghanis pay them income or dividend or interest or whatever you say, then China, we record it as negative, but China recorded as positive. Non-factor income, it's basically the income from tourism, from insurance, from software services, from banking services, from shipping. So all these transactions are recorded in the current account under the current account of the balance of payment of a country. And third portion of the current account is transfer payments, which consists of gifts, remittances, and grants, which I earlier discussed. So this is a balance of payment, one of the portion of the balance of payment of the United States. It's for the year 2000. So it's current account, the first portion of the balance of payments. It says exports of goods and services and income receipts. So under this we have three types of receipts. You see, receipts are reported as positive figures, while payments are recorded as outflow is recorded as negative figures. And this is the net of all positive and net of all negative. So the positive figures, we have goods import. We can say these are our exports, and exports, we have made exports of goods, and because of that we have received $772,210 million, right? So that's about 7.7 trillion. Then we have income from services. It means that American working outside America, their investments, they have received income which equals to 293,492, which is 29.3 trillion. And then we have income receipts, and that is about $35.2 trillion. If we add up all these figures, it will become $14.1 trillion, right? Okay. Now we come to, sorry, I think it's in billion. Million, these figures are in millions, and if we convert them to the hundreds, it's become billion, and if we convert them to the thousands, it becomes trillion. So then we have other heads, outflow from imports. You see, America has more imports than the exports. Means America purchases a lot of commodities outside America, and those are brought into America. And why do they do that? There is a purpose behind that, because they want to circulate the dollars. They are the owner of the dollar. They print the dollars, and dollar is international currency. So that's why instead of purchasing within the country, they purchase outside the country, so the dollar is exported out to the world. So there is no devaluation of dollar within that country. So with this, the dollars is always in circulation. And services, it means that people working in America, an American paying for their services, which is also $21.7 billion, which is less than what they are receiving. And then we have income payments. You see, it's $36.7 billion, means Americans are paying more grants, paying more income to the people. It shows that most of the people from around the world, they invest in America, they bring money to America, right? Through this way they export out the dollar, but through this way they import, right? They import back the dollars. So there is a circulation. You understand what I'm saying? So basically there are more people of around the world, they invest in American soil, they invest in financial securities of America. That's why America is paying more income on those financial investments than receiving. You see, there is difference. So if we add these three figures, it's 1.8 trillion, we can say, dollars. So it's 1.4 trillion, it's 1.8 trillion. So you can see America's current account shows a trade deficit, right? It's a trade deficit. It shows a negative, means America under current account, more money is going out of the America than coming into the America. I mean the dollar. Now here you see the last one, unilateral current transfers, which is aids. As America is a powerful country, they always pay grants and unilateral loans and gifts and aids to other countries. So that's why that's a negative figure. It's $5.4 billion they are paying. So if we add up all these three, if you add all 1, 2, 3, you will see the balance on current account, it would be negative with $4.4 billion, right? Or $44 million or $4.4 billion. It shows a trade deficit, right? Now here it shows deficit. You will see that this deficit will be compensated by the money coming in to America, and which will be recorded under the financial and capital and financial account. Through that source, the money is imported into the country, and through this source the money is exported out of the country, and that's how the dollar circulates on international market. Hope you have understood this one. If you have any questions, please put your questions forward. Inshallah, I'll be more than happy to answer. Now we have capital and financial account. It's the summary of flow of funds resulting from sales of the financial assets, purchase between one specific country and all the other countries over a specified period of time. It's basically sale or purchase of financial assets, right? As I earlier discussed, it also includes unilateral current transfer, for example, debt forgiveness, transfers by immigrants, the sale or purchase of rights to natural resources or patents. So all these transactions are recorded under. So what are recorded? Number one, sale or purchase of financial assets, right? Number two, unilateral current transfers, including debt forgiveness, transfers by immigrants, the sale or purchase of rights to natural resources or patents. These three specific things are recorded there. It compares the new foreign investment made by a country with foreign investment within a country over a period of time. So here it's basically foreign direct investment and foreign portfolio investment. Foreign direct investment means other nationals coming into a country and starting business there, purchasing buildings, purchasing companies over there. That's called foreign direct investment. For portfolio investment, it means coming the nationals of other countries coming into a specific country and buying the financial assets of American companies or American government, right? So all the transactions are recorded there. But also, not only these two such transactions, but also transfers by immigrants and sale or purchase of natural resources and patents. They're also recorded there. So here are three main components of capital and financial account: foreign direct investment, portfolio investment, and other investments, as I earlier mentioned in my previous discussion. So that's the structure of capital and financial account. There is a balance on capital account, balance on financial account. And what is the balance? How can we get the balance? Capital transfer credits and capital transfer debits. All the pluses are subtracted from the minuses, and you get the balance. This balance could be a negative figure or positive figure. Usually on capital and financial accounts, we have a positive figure, and that positive figure is usually equal to the negative figure of the current account. So here the account is balanced. The balance of payment account can be crossed and balanced. Third, we have official settlement account. It's a sum of current account and the capital financial account. A negative official settlement balance may include that a country is draining its official international reserves, assets, or maybe incurring debts to foreign central banks. Official reserve represent the holdings of the government or financial agencies. That means of the payment that are generally accepted for the settlement of the international claims. Previously, I earlier discussed that the negative balance of the current account should be equal to the positive balance of capital and financial account, right? In case these balances are not equal, right, then we will record, in order to make them equal, we will go ahead and record that under official settlement account. I'll give you an example. For example, the current account balance of payments of Afghanistan, the current account shows a deficit, right? Then the capital and financial account shows a positive. But the deficit of the current account is more than the deficit surplus of the capital and financial account. For example, on current account, we have $5 million of deficit, while the balance of capital and financial account shows a positive figure with $4.5 billion. But still, the deficit of current account is more than the surplus of the capital and financial account. In how much? $5 million. Now, in order to settle, look, the balance of payments should always be zero and equal on all three components that we discussed. So in order to settle the balance of payment account, we need to go ahead and record transaction in the official settlement account. In order to do that, we will first do omission of errors, as these statistics are taken from various sources by the government agencies and then recorded in millions and billions. So there is a possibility that there could be some ups and downs in collection of data. So those figures may not be actual. So we say it's 5 billion. So we say 5 million deficit. So we say 1 million is the correction, right? The error omission. So we consider that as a positive figure. Then what do we do? Then the remaining 4 million, it will be taken from the reserves, the international reserves that government keeps. And reserves include what? Reserves include Here we discussed previously the reserves include gold, foreign exchange, and IMF loans. So now Afghanistan, we will take that example. Afghanistan is in deficit of 4 million after putting an error omission factor of 1 million. Still we are in 4 million deficit. So this 4 million will be, some of them will be taken from the foreign exchange reserves, and some of them will be taken from the gold reserves, and some of them, for example, we took out say 2 million from the foreign exchange reserve in order to tally the balance of payments. Remaining 2 million we will take IMF loans, so that we will record as positive figures, and then we will add them all. Our balance of payment will be 0 and it will be settled. In case, what if our balance of payment shows a positive figure? Then what we will do, we have to tally the balance of payments. Then we will record it as loans or foreign reserves. Negative figures means we will record them as a payment to other countries, so that will nullify our balance of payments. I'll show you a sample balance of payment, hypothetical balance of payment, and then a practical balance of payment, analytical balance of payment of United States of America. Hypothetical means it's based on hypothesis. There is no real data, it's just figures. But analytical means that this figure is taken from the valid source, and there are at least 2 years we can compare, and then we can analyze how much is the change. It's a positive change on each item or a negative change. You can see here, this is analytical and this is hypothetical, right? Okay. All right, so you understand all this. I have already explained that. You can see here it's a 31 million deficit current account. It's also 37.5 millions of dollars deficit. Means each year America is in deficit, and from previous year the deficit has increased to 18%, which means that America is keeping more importing goods from the other countries. Okay, now we come to capital and financial account. Under capital and financial account, you can see financial account balance is positive 42 million, and here 48 million. There's 14% increase. So you can see there was 18% increase in deficit, but 14% increase in surplus. So you can see there is 4% difference. Means a balance of payment of the payments of America, of USA, has a deficit of 4%, which could be multi-millions. So let's see how much is that million. In millions, it's about okay. It's the positive figure. You can see it's 37 and it's 48. So it means that we have deficit on current account by 37 million, but we have financial account surplus for 48 million. There is 10 million surplus that we have. So here they have recorded omissions, error omissions, like 1 million they have put as an error omission. That they believe that this data could be over reported due to some reasons, so they have also reported as 1 million. So now this plus this becomes 12 million surplus, right? So how this is nullified now? You can see reserves, assets. So official reserves, they have divided 12 million into official reserves and use of funds, credit and loans, right? So they have done financing, right? So they have they have paid as an official reserves 8 million and 3 million as credit loans. So this together becomes 12.01, and here we had 12.0015 as positive, 12.015 as negative. So these two cross themselves and the balance of payments become nullified and settled. So that's basically official settlement account, this part, official settlement account, and that is the hypothetical balance of payment. Please study this balance of payment of United States of America or maybe of some other countries. Download a few balance of payments, read it based on the information that I have given to you. If you could not read it and if you have a doubt in any item, please take a snapshot and share that on the WhatsApp group and ask me to explain, and I will explain to you. Thank you so much. This is enough for today. Inshallah, we'll have next session for the new with the new topic. Thank you so much.